The US economy is on the brink of a recession. The first quarter of 2025 was a negative GDP growth, and we only need 2 consecutive GDP growth in order to have a recession. The unemployment is rising, and the Federal Reserve is considering to lower interest rates to avoid the potential recession. On the other side, the stock market is growing faster than ever. Over the last 12 months alone, the S&P 500 has grown by about 17%. That is double than the historical growth of about 8 to 10%. And most of that growth was fueled by the AI investments. Companies are trying to take the best advantage out of AI, so they're massively investing billions of dollars into new projects. On the other side, investors are also trying to buy the stocks of the companies that will potentially take the best advantage out of AI. Everybody is looking at the AI as if it's the new internet, and nobody wants to miss this opportunity. But a lot of people will say that the stock market does not always mirror the economy, because the economy is one thing and the stock market is a completely different thing. While on one side it makes sense, the stock market always catches up with the economy. At the end of the day, stock valuation should be backed by real earnings. And if the economy is slowing down, then the earnings are going to slow down, and you cannot possibly justify those high valuations. Which is why if the economy is going to slow down, in the short run, the stock market might grow. But in the long run, it will turn into a bubble and will follow the economy and will collapse. So the real question is that if the AI bubble is going to burst, which are the first stocks that you should absolutely buy to make sure that you will take best advantage out of this new revolution that is happening right in front of us? But before we answer that question, we have to understand the difference between value stocks and the growth stocks. If you pick up any company out of the stock market, you will find out that it is either a matured business, which means that it has already been in the market long enough and has dominated its industry, and it has built a very proven business model. It has constant streams of revenue, and no matter what happens, it will continue making that much money. On the other side, we don't expect these companies to grow exponentially because they have already matured. Think about companies such as Apple or Coca-Cola. Just because there is going to be a stock market crash, for example, tomorrow, it does not mean that people will stop using iPhones. The demand for iPhones is not going to go anywhere. People won't stop using App Store. So Apple is not going to see much of its stock price to crash. The same thing would go to Coca-Cola. Just because the stock market is crashed, people won't stop drinking Coca-Cola, which means that it's not going to impact much the earnings of Coca-Cola, which means that its stock price won't see a significant decline. And that's why these companies usually have the standard PE ratio of their companies or their industries. On the other side, we have the growth stocks. Now, there is a huge expectations for these companies, and usually you see these companies not making a lot of money today. However, investors are overpaying for these stocks because they believe that this is the company that has a huge potential to 10x or 20 times grow their earnings in the next 5 to 10 years, for example. And that's why when the stock market is growing, you see their stock prices grow dramatically. But at the same time, when the stock market is collapsing, you will see that those expectations evaporate and those stocks actually decline the most. Think about companies such as Palantir. Palantir is not making much of the money today. However, investors have so much expectations for this company that they're willing to pay extra amounts of money for this stock because they expect that the entire Pentagon will be run on Palantir, as if Palantir has won a contract for $100 billion from the entire NATO. That's why usually these companies have high PE ratio. So the question is that which of these stocks will suffer the most during a financial crisis? Now, to answer that question, we have to understand the basic concept of how the stock market works. Human emotion is the primary factor that drives the stock market in the short run. When the stock market is growing tremendously, it is growing because there is so much optimism about the market. People will start thinking optimistically, they will grow their expectations, and because their expectations are so high about a particular company or an industry, they are willing to overpay. Because there is something called the fear of missing out. People are afraid that everybody else is making money, everything is growing, so let me jump in and buy. Now, the best example I can give you is the 2016 or 2017 Bitcoin growth. The price of Bitcoin was growing so much that back in the days, like, most people had no idea what Bitcoin is. Like, literally, you would see celebrities spending so much money buying Bitcoin. And then Bitcoin collapses. And then celebrities, they started suing the people who told them to buy Bitcoin. Because these people bought Bitcoin not because they're like, oh, this technology is going to change the world, even though that this technology will potentially change the world in some time in the future. It needs time to develop. But those people purchased it because they had these high expectations. And it happens in the market every single time. Now, Isaac Newton is potentially one of the smartest people that has ever lived in entire human history. But Isaac Newton at the same time was an investor. So he comes across a company called South Sea and he buys a lot of shares of this company. Suddenly, the price of South Sea grows dramatically and he's like, it's time to sell. He sells his stocks, makes a lot of money, and he's a very rich man right now. However, as he watches the price of South Sea keeps growing dramatically because there are a lot of rumors that this company is going to dominate the entire industry and everybody is rushing to buy the stock of South Sea. So the stock keeps rising and rising and rising. And Isaac Newton's sitting there and he's like confused. Why on earth did I sell my stocks? I would have made a lot more money. So he takes pretty much most of his wealth or most of the money that he made from this deal prior to that, and he buys the stocks of South Sea. But it was turning into a bubble. The price grows and grows, and then the bubble bursts, and then the stock price collapses, and Isaac Newton loses everything that he invested in this company. And Isaac Newton is one of the smartest people that has ever lived. So if Isaac Newton makes such a mistake and his primary investing decisions are emotional decisions, think about what is happening with the rest of the market. And even though that we are in 2025, the fundamentals of that haven't actually changed, and most people in the market, even a lot of professional investors, still base their decisions on their emotions. And that always turns into a self-fulfilling prophecy. For example, when the stock market starts to collapse and the stock market is going down, people are afraid, their expectations suddenly vanish, and they start selling their stocks. When everybody is selling their stocks, there is more supply of that stock in the market and less demand. It turns into a self-fulfilling prophecy and the stock price goes down, which forces more people to sell their stocks, and so on and so forth. When you understand that, that's when you can actually see what is happening with the growth stocks and value stocks. Because there is so much high expectations about the growth stocks, the crash of the growth stocks is going to be significantly bigger than value stocks. Because with the value stocks, everybody knows their intrinsic value. We know that this is Coca-Cola, this is their client base, this is how much money they make, so their stock prices is being backed by their earnings, so it's not going to crush much because there is so much certainty about its valuation. And at the same time, when the market is growing tremendously, for example, over the last 2.5 years as this AI mania started, you don't see Coca-Cola stock growing tremendously as much as you see, for example, Palantir stock is growing. Another thing to pay attention with the growth stocks is that there are a lot of speculators who are buying and selling the stock. Now, the speculators are not trying to make money in the long run. They're trying to make money in the short run. So when you have a stock or a company that is on the way to dominate an industry, and we don't know whether that will happen or not, even if the chances are 70%, there is always a chance that the competitor will take the entire industry and will outperform them. And because their valuation isn't actually clear, speculators can speculate and buy and sell in the short run. But when the market is crashing, speculators get out of the market, sell their stocks, increase the supply of the stock in the market, which lead the stock price to collapse. And that's why whenever you're trying to take advantage out of it and you're thinking which stocks are going to fall the most out of when there is a financial crisis or when there is a stock market crash, you will see that growth stocks will suffer the most. And these are the type of stocks that you should be paying a lot of attention to. And these are the stocks that if you buy when the entire market crushed, you will benefit the most when the market will grow again. The best example is, of course, Amazon. Now, Amazon today is the most successful e-commerce company in the world and one of the companies that literally shaped the internet. But in late 1990s, it was one out of many companies. The dot-com bubble burst and Amazon stock goes down by about 95%. Now, back in the days, a lot of people would think that, well, why would you even buy Amazon? But Amazon was a growth stock because everybody who knew how the internet works understood that internet will dominate the world, and Amazon was in that position, which was building the essential services for Amazon to dominate the internet. And today Amazon is one of the most valuable companies in the world. When the AI bubble is going to burst, the question is, which are the top 3 stocks that everybody should be watching and buying when the bubble is going to burst, because they have the best advantage or the best position to grow exponentially because of AI. Now, the number 1 stock that I'm very carefully watching is Oracle. Since the AI thing started, the price of Oracle stock has grown by 300%, and it was one of the fastest growing stocks literally in the market. For example, back in 2023 or the beginning of 2023, the PE ratio of Oracle was 25. Today, it's 52. Now, PE ratio is by far not a single indicator that you should be watching, but PE ratio is simply telling you, or that growth in the PE ratio is that investors are overpaying for Oracle because their expectations of this company is huge. But why is that the case? The entire business model of Oracle is managing databases. They have been managing the databases of so many businesses literally since 1990s. Their entire business model was that store, organize, and manage data for most of the businesses. So their business model is B2B. Oracle provides databases software and the infrastructure for financial institutions such as banks, for governments, for literally any business that wants that. So over the last 30 years, they have gathered so much data. And then they started introducing softwares that will help them to use this data to improve their efficiency, to improve their decision making, to improve their forecasting, which is actually a very great service for businesses. Now, the question is, what is happening when you introduce AI into the structure? You have the data and you have the services. AI is simply going to speed up and make the entire thing much more efficient. Now, I want to ask you a different question now. Does it remind you of another company that is doing very similar thing? Yes. So Oracle is the best positioned company to compete with Palantir. In fact, I would even say that Oracle has the infrastructure to even beat Palantir and take most of their contracts. So Palantir is now running around over the last 3 years and signing contracts with governments, countries, NATO members, the police, literally militaries all across the globe. Oracle is not doing that yet, but they have the entire infrastructure. So I would not be surprised if they would literally snitch a big share of that market from Palantir to themselves. There is so much expectations about the company, but it's not yet backed by earnings, which is why during the AI bubbles burst, it is one of the first companies that is going to see their stock prices drop significantly. But if you think about it logically, over the long run, this is one of the companies that will most likely benefit the most out of AI because that's how their business model works. AI will benefit their business model probably more than any other business. Now, the second company that is on my list is CoreWeave. This is the company that literally is trying to become the Amazon Web Services for AI. They're literally building those databases and they're filling them with GPUs and then providing the AI infrastructure for any company that wants to build its AI. So Amazon back in the days, they would provide this they will build these data centers and they will provide cloud computing services to businesses, small businesses, big businesses, so that if you want to build an online business, you don't need your databases. You can simply rent it from Amazon Web Services. Now, this company is trying to do the exact same thing, but for AI, to the extent that NVIDIA purchased 7% of this company. This is how much NVIDIA believes. When you own 7% of another business, especially when it's a publicly traded business, it tells a lot about your confidence in this business. Now, there is so much expectations that this business is going to dominate the entire market. Now, we don't know that for a fact because we have multiple other competitors who are trying to compete with this company over this industry. They need time to build that infrastructure and it's going to take them years. But if they won't build it before the AI bubble hype is going to burst, then most likely they will see their stock prices crash as well. The third stock is obviously Palantir, because this stock has been going so high over the last 2.5 years that it's very difficult to believe what's happening. Investors are evaluating Palantir as if Palantir got a $100 billion contract from Pentagon. Yes, they got so many contracts from the Air Force, from the Army, from the military, from other NATO members, from governments, but it's not to the extent to justify the current stock price. Like, the expectations of investors are here, their potential earnings are here, because investors believe that they will actually reach there. Now, it will take them a lot of time. It's going to take them at least a few years, like 5 years is the least. But if the AI bubble bursts within the 5 years, then they will have a reality check and you will see Palantir stock crushing drastically over. It's going to be like one of the first companies that will crash out of the AI burst or out of the AI bubble burst. But Palantir is a guaranteed $1 trillion company in the long run. There is no question about it, which is why when the AI bubble is going to burst, this stock is probably on the checklist of every single person who wants to benefit out of AI. So these are the 3 stocks that I'm watching very carefully, that if there is going to be an AI bubble burst, then I'm going to literally take all the money I have and will literally throw them into these 3 companies. That's it for today. Thanks guys for watching, and I will see you in the next one.